Hey everyone, I'm Anthony, and today we're diving into a fascinating shift happening in Hong Kong's IPO market. For decades, Hong Kong was the premier destination for companies to go public, attracting giants like Alibaba and China's biggest banks. Its success stemmed from a robust legal system, free-flowing capital, and world-class regulations, all under the one country, two systems framework. However, around 2020, Hong Kong's IPO market faced a significant downturn, with fundraising plummeting to just 46 billion Hong Kong dollars by 2023. This 56% drop from the previous year marked its lowest point in 2 decades, causing its global IPO hub ranking to slip to sixth, behind cities like Jakarta and Mumbai. This decline was triggered by a perfect storm of four major factors, fundamentally reshaping its financial landscape. First, geopolitical tensions between the US and China, alongside laws like the Foreign Companies Accountability Act, pushed Chinese firms away from American markets. Second, Beijing's regulatory crackdown on tech giants, exemplified by the cancelled Ant Group IPO in 2020, deterred investors with unpredictable policies. Third, Hong Kong's national security law, passed in 2020, raised concerns about the city's independence and neutrality as a financial hub. Finally, global economic headwinds, including rising interest rates and China's post-COVID slowdown, reduced investor appetite for risky IPOs. Facing this market freefall, Beijing intervened significantly, introducing a set of 5 measures in 2024 to revive Hong Kong's markets. These measures included expanding Stock Connect for mainland investment, adding REITs, facilitating RMB trading, easing fund access, and fast-tracking approvals for major Chinese companies to list. While these actions led to a reported 228% surge in IPO activity, it was clearly Beijing calling the shots, not the free market. Beijing also deployed its national team, state-backed funds, and massive state-owned enterprises, or SOEs, to stabilize and stimulate the market. These SOEs have a dual mission: to generate profits and to serve national strategic goals, acting as anchors in the market. The national team often acts as cornerstone investors, securing large portions of IPO shares to guarantee success, raising questions about market authenticity. Adding to this, Beijing introduced new rules in 2023 requiring all Chinese companies listing abroad to obtain its approval, blurring regulatory lines. This means companies, even those with offshore structures, now face dual hurdles: Hong Kong's listing rules and Beijing's green light, which prioritizes national security. The national security law has also created a chilling effect, leading to self-censorship among analysts and journalists, which harms market transparency. Without independent research and open media scrutiny, investor trust erodes, leading to capital outflows and a shift from Western to mainland and Middle Eastern funds. In essence, Hong Kong's IPO market is no longer what it once was. Beijing's interventions are propping it up, but at the cost of its freedom, diversity, and transparency. While these moves might boost short-term numbers, Hong Kong risks losing its global financial center status to rivals like Singapore or Tokyo. It could become merely an offshore extension of China's financial system, a significant departure from its past as a neutral, global stage. Hong Kong stands at a crossroads. Will it remain a global financial powerhouse, or will it morph into a specialized hub serving China's national goals? Beijing's hand of the state has kept the IPO market afloat, but it has fundamentally rewritten its DNA. For investors and observers, the rules have changed. The market's future depends less on Adam Smith's invisible hand and more on Beijing's very visible one. What do you think? Can Hong Kong bounce back as a truly global player, or is it locked into a new role? Drop your thoughts in the comments. If you found this deep dive into Hong Kong's financial transformation eye-opening, hit that like button and subscribe for more breakdowns of global markets and trends. See you in the next video.